Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to today's show. Today we have Feras and Ben. They're the two managing partners of Disrupt Equity based in Houston, Texas. Combined, they've acquired and managed over 1,700 units across Texas and Georgia. Feras and Ben both come from a technology background and leverage technology to help them be more efficient and effective. Today, Disrupt Equity is vertically integrated with their in-house property management called Disrupt Management. Welcome to the show, guys.
Hey, Ryan, thanks for having us.
Thanks for having us on, buddy.
Thanks for making the time for us. Well, let's jump right in. Walk us through your backgrounds. Tell the listeners a little bit about yourselves.
And I'll go first. So my background, grew up here in Texas, so we are based here in Houston. Kind of grew up in Houston, went to college in Austin, University of Texas, UT Longhorn. And, graduated computer science, right? I've always been entrepreneurial, always had a web background, had my own little business in high school, and ended up interning at Microsoft almost accidentally, decided to go full-time. And I told myself 2 years and I was out. So I stayed 2.5 years, waited until we were kind of at a good point in terms of the release schedule. So I left on good terms and left and started a software company. Did that for several years and started investing in real estate almost accidentally, right? I did my first, I knew I wanted to get into it. I bought my first fourplex. First purchase ever was a fourplex. Or about a house or anything. It's actually like a mile down the road from here.
Oh, nice.
So small world. But, bought that, kind of got a taste for multifamily, did residential, and kind of grew a rental portfolio, realized it doesn't scale very well. And, from that kind of got into multifamily, started looking at that, learning a lot more, learned about syndication, fell in love with syndication. It's the things I like. It's people, it's numbers, it's systems, right? And kind of, we started Disrupt Equity, and then we kind of met then, and we've been rocking and rolling since then.
Yeah. And so, Ryan, as you had alluded, I come from an IT background as well. Started an IT company about 10 years, maybe 12 years ago at this point. And, it's based here in Houston, did a lot of the hardware for government and corporate clients. So, kind of learned the whole IT. I always kind of tell people I came from the sales and business development background. He was kind of one of the smart guys. I was the guy telling everybody how much stuff costs. So, learned a lot of sales, marketing, business development in that role, management in that role. Got into real estate in 2013, just like Feras, started off with the single family route, did some fix and flips, did some wholesaling, had a couple rentals. And then from there, kind of just like the epiphany that Feras had, right? It's not a scalable way to get into real estate. Now, don't get me wrong, for your listeners, right? There's people that can be wildly successful in single family. It just really wasn't for me. So I started kind of looking to get into commercial real estate, and that's where I stumbled into multifamily. Got into that space in about 2015, and we've been rocking and rolling ever since.
I think it'd be helpful. Obviously you guys have formed a strong partnership and hosted a great meetup and done a lot of great things together. So just walk us through how you all met and kind of the working dynamics amongst your partnership.
Yeah. All right, I'll go through that one. So it's funny because I have a little joke here. So, I was learning to get into multifamily. At the time, there was almost no meetups in Houston. Well, one of the few meetups that did exist was the one Ben had started. So he did have a meetup. He was, he had kind of running for a while. It was kind of hit or miss on attendance at the time, right? You'd have sometimes you'd have a decent crowd. Sometimes it'd be a hurricane and people wouldn't show up. So a little bit of something's outside of his control. But that's good, right? That's actually for the better because then I got to know Ben a lot better, right? Versus it being 50 people every time, I barely get to talk to Ben. So I think that was the benefit. Got to know him a lot better. Realized, very like-minded. I had other partnerships before, kind of knew what to look for in a partner, what makes a good partnership, and kind of had a deal in Atlanta we're looking at. And I was like, hey, originally I like to say we weren't exclusive, right? Kind of just testing the waters. Realized, let's do that deal together, and obviously kind of realized we both had the same goals, the same work ethic, and kind of run together since then. And then we systematized the meetup and got that consistent. Because my joke is basically Ben would hold his thumb to the wind, let's do a meetup tomorrow, right? It was very, I wouldn't know when the meetup was besides whenever the announcement came. And so
I try to keep it consistent on a monthly basis. Now the day of the month, that was a different story, right? And how many people would show up. I always tell people I was running it for 2 or 3 years before we partnered up, and I never had a check-in list. I never had
that's what kills me for all this time. That never had a sign-in list or anything.
And I think back on some of the people that I've met. I'm like, dang, that guy, I should have gotten him on my list, and I never did. And then you can't go back because you don't have any kind of check-in list. But so I mean,
the important thing, you get started the meetup, taking the gusto to go do that, which very few people have.
I think that's where it's kind of good, right? Like Feras really is good at kind of the technology and systematizing things, right? And really quantifying things, and that's kind of what I needed. So you're always looking for a partner that's that's going to kind of, where you have a weakness, they have a strength, right? And vice versa. And you can kind of build something on top of each other. I think,
the other part of that too, just to add to two things, I guess, is it's having a partner with the same work ethic.
Yeah.
Right. Like me and Ben will exchange emails 10 p.m., 10 a.m., 9, whatever, pick a time where, we both have the same long-term goal. That's the other big part of it too, right? Our goal is not a quick one short-term horizon. It's a long-term horizon. How do we get from where we are to where we're trying to go? So I want to go too far down that rabbit hole. We'd be happy to answer more questions, but that's kind of maybe the high level.
No. I think those are probably the two biggest ones. Do they have the same goals, and do they have the same work ethic? Because we've both been in partnerships where that has not been aligned, and I think that's where people that are looking, should I do it on my own or should I partner? Right? You really have to look back, and the other thing too, if you're going to do it on your own, do you have enough time to do it on your own? Do you have enough resources to do it on your own? Because at some point you're going to run out of those things, right? And, I always tell people like, hey, you could probably do it on your own if you have $100 million in the bank, but if you got $100 million in the bank, why the heck would you do it in the first place? Right? Because the other thing that we always tell people is this is not an easy job. Yes. Could there be very good rewards? Absolutely. But there's a lot of risk and there's a ton of work to be involved when you're building a syndication business and when you're just being an entrepreneur in general, which is really what we consider ourselves.
No, that's great. I appreciate the insight and input. So, talk about where you are in the evolution of Disrupt Equity from, having started your partnership a few years ago and now bringing property management in-house. Just walk us through kind of what the vision is for this year and the next few years.
Yeah. So, I mean, we're growing. That's the good news, right? So Disrupt Equity, I like to say we're a private equity firm, right? More, multifamily is what we do. That's our bread and butter. That's our expertise, right? But, we are constantly looking at how do we continue to refine what we have, right? Do things better. And then really, how do we start to add more value to our investors as well as the business, right? So bringing management in-house was a huge, first step, right? That's been awesome. I mean, we go from, little payroll just from the back office to a huge payroll that has its own benefits, right? And then really being able to manage the deals tightly. Right. And then kind of the next forefront from there is really, okay, what else can we do that can help the property as well as maybe be an ancillary business? And so for us, our end goal is getting to 10,000 units, right? How do we do that while being vertically integrated and just reimagining a lot of the minutia today? I mean, there's so many assumptions baked into this world and people hop in and just start managing, don't really think things through and don't really care, right? And so we're really looking at how do we do things a little differently than what everyone else has been doing, right? For our own greater good as well as, any future customers.
Yeah. And I mean, we create businesses when we feel we need to create them, and then we're also open to, kind of an M&A stage, which is, I think, kind of where we're going to find ourselves over the next probably 1 to 2 years, where we'll merge or acquire businesses that are ancillary to what we're doing, but also as a whole, as a vertical stack makes sense, right? Because they're going to make the whole stack more profitable or more efficient or more productive. And so that's the other stage that we're kind of finding ourselves evolving into is, the multifamily is our bread and butter, but there's other ancillary businesses that we're going to start, getting into over the next few months that I think are going to help not only us, but help out other sponsors, other owners, other investors, and just people in the space and make them more successful. And that's what we're trying to work for too.
I think management's a perfect example, right? We think management is totally broken. No one has done it right. We're here to disrupt management, right? And really rethink that business. Now, that helps us. Our deals perform, so much better than they were before. I mean, our first month, our payroll was like 2/3 what it used to be, right? There's so much minutia that gets baked into these numbers with some of these property managers. It's crazy, right? And so not only does that let us help manage our deals better and our deals perform better, right, which turns into better returns for our investors, it also lets us, even on the acquisition side, we know how we can operate these deals. We don't have to bake in a lot of fat that we know the property managers are, right? So it gives us that competitive advantage. And then the third part of that too is other sponsors, other people, right? That becomes its own business because we've guinea pigged it on ourselves, spent a lot of time reimagining some of this, right? How do we give, and we've looked from the get-go, we designed it as its own business, right? There is that separation, it's its own entity, it's its own, person running it, et cetera. And, how do we treat it to where, okay, we are just a client to that business, right? How do we solve all the things that are needed in that case? And, look at it from that lens. So that way, whenever we bring on other people, right, we can kind of make sure that it's ready to go.
Yeah, we're slapping, our technology, our sales, our marketing, our platforms on top of these businesses. And I think that adds value to the current business, but it also adds value to the people that are coming on as clients, right? And so, that's important from a management perspective. And Feras brought up a good point too. It gives us the flexibility to, do things a little bit differently than you would, having to work with a traditional third party, right? If we've got questions, guess what? Jackie, who's the president of our property management company, is right down the hall from us.
Or even better than that, if we've got questions, we open up Slack and you can see all the interactions with the staff and see what's going on, right? There's this level of transparency that's been lacking for the past 20 years of property management. It's very, very broken. We can talk hours about that.
Sure.
Ryan, let's go grab lunch once the world's back to normal and we can kind of, share. But it's those kind of examples, right, of businesses where it's dated. Because, I guess I left Microsoft with the vision of building software for businesses that don't have it. I've since realized the opportunity, and by business, I mean real industries that don't have it, like real estate. I've since realized the opportunity is more so be a good business owner, right, and leverage technology to make you so much more efficient than everyone else, right? And then do it as a team, right? That's the power, kind of going back to the partnership, right? I know Ben will hop in and do anything that is needed for the business and likewise, right? Just kind of, we have the same long goals.
Yeah, a lot of these industries that revolve around what we do are all stuck in the 90s. And from just printing reams of paper to the communication style and the platforms of how they communicate.
One of the first things we did, digitize every single invoice, and I brought on a team of VAs to help do all the digitization, audit it all, and answer phone calls, right? Like reimagining that business. A big thing we do throughout the company, regardless of what part of the business or which business it's about, how do you have the expert get to do the things that they are really good at and remove all the minutia so they can do the thing they're good at more than they do the minutia.
Yeah, absolutely.
Yeah, walk us through a little bit more about how you're leveraging technology, given your backgrounds and given kind of the disrupt nature that you're trying to institute in the multifamily space.
The first and foremost, right, and we've kind of learned along the way, the biggest thing that property management companies all screw up is you have these stupid weekly calls where everyone is talking about things that need to happen, and then great, you have to hope someone took notes somewhere, and does that person have the same things that you track? It's this super disconnected thing. Simplest solution to that, right? We have one project, we use Asana. Asana is a task management system. There's a lot of them. Asana is the one that we use for a variety of reasons, but we have one project that our on-site staff is on, our asset manager is on, we're on, and our property management company is on. There's one source of truth, and everyone knows who's working on what, and things get assigned to people with due dates, right? So now that solves two problems. The first problem is there is that level of visibility and transparency where everyone knows what needs to be worked on. There's not this, oh, I forgot about this thing. No, that's BS. It's in here. You should be checking it. And the second thing that it solves is, it moved on. Yeah, I knew I had two thoughts. It was basically about not requiring, because the problem is these weeklies happen once a week usually, and nothing gets done until that call. But now, we can go in daily and ping and hey, what's going on with this, right? We don't have to have to wait for the weekly to get that communication. Things are constantly moving on. And on top of that too, maybe Ben gets an email about something that needs to happen. He can go in and create the task right then and there and assign it to the on-site manager. My manager doesn't have to wait for the weeklies, right? So that's one example.
I would say, just to add to that specific example, coming from a less technological background and more of a sales background, what I loved about that whole process was that a VA was actually the one that was scribing the whole entire meeting, the weekly call that we have, right, and assigning tasks. So if you look at it like, oh, that's just another thing that the on-site manager is going to have to do with the regional or somebody on the ownership side, no, the VA is already doing all that, right?
Yes. For those
And
who don't understand,
assigning-
VA is virtual assistant that we have in the Philippines. And like Ben said, she's on the call, she's taking notes, she's assigning tasks, she's kind of whipping it into shape.
Yeah.
Right. So again, another evolution to help just make that process easier.
Put due dates to it, and then, hey, so-and-so, the on-site manager, this is due today. Where are we at with that? They also bird dog the actual task themselves. So it really takes a lot of this minutia. I think a lot of people just in general, business owners or syndicators or sponsors or whatever, get caught up in the details of the process, right? And so if you can automate that, you can streamline that, you can make that whole entire process as efficient as possible, that frees us up. And let's just take the syndicator, role that we're in. That frees us up to go find more deals, to talk with our investors, right? The highest and best use of our time, that's where I want to be, not assigning tasks and doing just the day-to-day minutia stuff that you can kind of get caught up in as a syndicator. And that's important for people to know. So that, I would say for me, that was the biggest takeaway. Like, wow, this is powerful. That just freed up 25% of my day.
Sure.
And so for a lot of people, like, they don't know what could you do for, an extra couple hours a day. You go spend it with your family. You could go find more deals. You could do any number of more productive things.
So that's just one of 10 different tools that we use, right?
Sure.
We use Slack for communication as well. We have a channel for every different property. We have channels for other things. And, me and Ben, for example, we can get a pulse on what's going on the property. We don't chime into those channels, right? We don't want the staff to feel like we're, looking over everything, but we get a pulse of what's going on, right? Something happens at a property, we can, we're catching up on things. So there's that level of transparency, right? Where as an owner, usually with weeklies, it's only whatever they remember to mention happened, right? Then you find out, a while later that something happened that they should have mentioned to you, that, there was a fire in a unit or something. It's like, really? Like, you don't mention these things? And so,
well, it's bundled up. It's bundled up in a way where, once again, if you're working with a third party, right, you're their client, they are going to bundle it and shine the best light on it as possible. And, they might just forget to tell you something. And I think where taking management in-house has really been powerful. It's just the transparency up and down the chain.
To be a good operator, you got to know the bad and the good, because really you're trying to solve the bad. You don't want the management company just trying to solve the bad the way they think about it. We need to also know that.
And you got things like pandemic, right? You need to be flexible and nimble very, very quickly, right? I can't have them sanitize every bad piece of information and then shine the best light on it and then tell me what they want to tell me, right? I want to know the good, the bad, and the ugly now, right? And then we can assign people to help them with whatever problem that might be. And this was the perfect kind of test case of, is that theory going to be good in practice? And it has been even better than
we took over pretty much our two of our hardest deals, period.
Yeah.
And it's been phenomenal. So that's another example. And even other things. How do you get consistent communication, right? Knowledge, like a central knowledge hub where people know to go there, find information. And how do you use that to communicate to tenants, right?
Yeah.
That's another example. Another one too is just like we have the ability now, and it's something we kind of force on the maintenance, is basically a unit becomes available. There's a checklist. They have to go in and take pictures of all the things that are that checklist, right? Before they're turning them. So maybe, they take a picture of the front door, they take a picture of the kitchen flooring, and they take a picture of the kitchen microwave. And then the maintenance person submits that purchase order, right? And now the purchase order, they say, I want to put new flooring and I want to get a new microwave. Well, our staff can see the pictures. Hey, is that flooring, does it need to be new or is that salvageable, right? Because a lot of times maintenance guys just approve whatever they want. It's not their money. They don't care as much, right? It's less work. And so then, we can kind of control what is getting done and what's getting not done. And then the most important part is at the finish line. So now that unit gets turned, right? Once it's ready, that maintenance guys to go in and take the same pictures. And you can see the before and after. As an owner, you can see, hey, they spent $5,000 on this unit. What the heck? Where'd it go? Oh, okay. I see why they spent $5,000. And then on top of that, you can kind of audit that PO. Hey, we ordered a new microwave. Did that microwave get installed? Or did it get stolen? Right. So there's a lot of this is not hard. It's about putting all this together. So
and
those are just some examples of it. Right?
Yeah, and syndicators really, they need to understand that, like, the one-off stuff, the variable stuff that you're just not going to be able to control, like that pipe burst underneath the foundation that's cost you $10,000, right? Where you can control your expenses is at the unit level, right? But a lot of the third parties, they're just doing whatever they got to do. There's a lot of leakage. There's a lot of theft. There's a lot of just laziness in general. And Feras brought up a good point, right? We have in the past spent a fortune on flooring. I mean, I'd like to the point where, I probably could have refloored a couple of these properties 2 or 3 times over, right? And it's because the maintenance guy or the manager or whomever is making these decisions, right? Once again, when you're working with a third party, it's hard to determine who actually made the call. Was just saying, oh, I can't clean that, or I don't want to clean that, so let's just give you flooring, right? So you rack up this tab. Now this gives you a little bit more control. And on top of that, right, people can no longer just send orders to our vendors, right? There has to be a PO. The PO has a dollar amount, that above that dollar amount has to be approved at the regional level. Above, they have a threshold too. Above that threshold, it has to
the
be
on-site staff will go wild. You'll find out a month and a half later that they racked up all these random things.
Sure.
And it's like, there's always the question, did this stuff even get done?
Yeah,
right? That's
no, you have no idea.
We take over our properties and we're going through like, did anyone even do anything here? And it just, so
this is accountability. It's about expense control. It's about, being honest about where things are going and what's happening at the property level. And so that's just another way that we've kind of introduced, technology to across the whole entire process.
So we're excited. I mean, with Guinea Pig, it's going really well. I mean, there's just every rock we pick up and kind of look around. There's, a mess to clean up and kind of organize, right, in terms of property management. So that's definitely been a big focus for us in getting that, going in the right direction. So, and technology is the solution to a lot of it. So
I appreciate all that insight. Are you building out new programs and things, or are some of these things off the shelf and then you're customizing them?
A little of both. I mean, we will build brand new software where we need to, right? I mean, we're not scared of that. That's at Microsoft. I was a project manager, and I've built software in every language you can probably imagine. I've done everything.
Wow, okay.
But a lot of it is more about, hey, rather than going and reinventing the wheel, how do we take things that are already out there and tie them together, right? And package them up, and there's an integration piece and layer, but it's really a lot of the stuff that's out there. It's more about knowing about it, finding out about it, taking the time to go research them. And then, figure out a rollout plan, right?
And that's a lot of problems for people that maybe come from the traditional real estate space or just some other space. They just don't know about a lot of this stuff, right? And so we've taken the time to do the research to try it out on our own properties and figure out what works, right? And then across the board, we just keep introducing things that make sense, right? Not to the point where it becomes a nuisance or a burden, right? We're not going to just introduce technology just to introduce technology, right? It has to make sense. But a lot of people are so overwhelmed, like, where do I even start, right? Well, we've already figured a lot of those pieces out. And that's the value.
And I mean, honestly, it hasn't been that hard. It's about, because you got to sell them on the value, right? We're doing these things because it will make their life easier, right? That's the most important thing. So you're selling them on the value of it and why they want to adopt it, right? And, I mean, honestly, every time, once they start, there's a little bit of a learning curve, and we have our VAs, they'll help, and they'll go get on Zoom and webinars or whatever and teach them how to use these things. But once they get started, they're excited. I mean, they see the value, right? And so a lot of times it sells itself, right? That's this thing that they've been lacking, and they didn't realize they're lacking until they, get the new thing, and they're like, well, dang, I can't believe we used to go the old way where, people would just text each other arbitrarily. There was no organization, none of that, right? And so it's bringing, a little bit of organization to the chaos. And that value, honestly, it sells itself most of the time. And if it doesn't sell itself, then there's a question of, should we be rolling that out to begin with, right? Yeah. And it goes back to, sorry, Ryan, not to cut you off. And it goes back to also the other part of that too, though, is the value sells itself, right? And as part of doing it, that person is now getting to spend more of their time doing the things that they want to do, or the things that is the better use of their time, right? And so,
what technology do you recommend, things that they could look into or use?
Full disclosure, Ryan, like, this was stuff, we've introduced a couple more of these since we brought management in-house. A lot of this was stuff that we were doing with syndicators too.
I would just say, I'll keep it simple. There's a lot of tools out there. I don't want to overwhelm people, but if you're not using Slack and the task management system like Asana today for your business, you're probably doing it the hard way. Definitely. Those are the two. If you learn nothing from this podcast besides rolling those two out, that is the value that you should go do. I mean, and have your property management companies use them, right? Like, literally dictate that to your management companies. And we've done that. We had them join our Asana, even third party. And so those are the two things, maybe the takeaways.
And the one thing,
that's great.
Just because we built Disrupt Equity is kind of a remote working, environment from the beginning. I mean, we've since got an office, but that's because of the property management company, right? You got to get on like a Zoom or some other similar platform, right? Because, having a face-to-face meeting, especially in these trying times that we're in right now, is huge. So people have to get comfortable with doing that type of stuff too. So if you incorporate a Zoom type platform plus the technology, you're going to be light years ahead of where a lot of people are right now.
No, that's great. We appreciate that. Thank you. Ben, you had mentioned pandemic. And so, the elephant in the room is COVID-19. So how are the properties performing through this crisis?
Wait, there's a pandemic going on?
Oh my gosh. No, it's unfortunately, we're shooting this, for your listeners. I don't know if it's going to be in the future. This is in April. So we're right in the middle of it. It's been a trying 3 or 4 weeks, right? I do feel comfortable with, the management side of it and us being proactive. A couple of the things that we've done, right, was create public-facing pages where we can constantly update links to rental assistance programs, to the TWC website, to the stimulus check updates, to PPP programs, anything that we feel is going to be of value to our on-site staff, to our residents. We are going to share that with them in real time, right? All they have is one link. You go here, it's got all the resources that you need to help yourself, right? Because as we all know, right, we have forbearance programs, which we'll talk about here in a minute. And you also got, there's a moratorium on evictions, right? But rents are still due. And so we're trying to be proactive and work with our residents and say, hey, I understand this is a troubling time for you. How can we help you, right? And giving them those tools to help themselves has been tremendous, right?
And the tenants realize that and appreciate that. They see we're working with them, right? And that in turn turns into a better community, right? I think some people take a very stern approach, which there's no value in that, right? For the other owners that are taking a very stern approach, even if you want to evict, you can't evict for the next few months. All the courts are closed, right? So why would you kind of take that approach and instead, listen to the tenant, document what's going on, right? And our staff will report back to us and say, here's what's going on with this person. What can we do to help, right? And, whether that's a payment plan, whether that giving them a month for free right now and then roll the rest of it into the next, the remainder of their lease, helping them find a job. There's a lot of other ways. And so just being essentially supportive for the tenant, right? And that gives them value. And guess what? Whenever it comes time for renew, they're probably going to want to renew, right? They see that you weren't just that landlord that was just threw that line in the sand. It's, hey, what's going on? How can we help? And listening.
We're all human beings. We got to be sympathetic, right? We're going through troubling times. They're going through troubling times too. So, we've all been there. So, I think taking that sympathetic approach and trying to be proactive and communicate with them has been huge. Collections is within 5 to 10%. I'm tracking it daily. We have a daily report and graphs that we put together that's on it. So we're not too far off right now. May will be the more questionable month, right? Because I think a lot of people, they paid April because, either A, they got their stimulus check, or B, they had enough reserves to pay April. But we're going to continue to be proactive, continue to communicate and provide the resources that people need and work with some of these charitable organizations, some of these other rental assistance programs and turn those on to our residents just so they can help them, with the rent for May. So we'll keep tracking that, but it's been a different way, right? Our offices are still open, but they're not open to the public, right? So collecting rent has been a different animal, right? A lot of our tenants, we do a lot of workforce housing, Class C and B stuff. They still give us checks, right? So how are we collecting those in an efficient enough way? So we've pushed a lot of people to do online payments. That has turned us into almost a de facto IT support, hotline, because a lot of people, believe it or not, just are not comfortable with doing a lot of things online, and us coming from technology, it's hard for us to kind of wrap our heads around it, but we're trying to be, once again, sympathetic and say, okay, go to this link. And so once again, we put all the 1, 2, 3, 4, 5, how do you pay rent online, and make that. So that's been another thing that's been different, right? Working with our lenders. Lenders have been flexible. We're not trying to take out forbearance. We haven't done that on any of our other properties. We've got other resources at our
forbearance has its own issues too. It's not just roses for all those listeners.
Yeah, and forbearance, for people that might not know, for your listeners, right? It's just, they're essentially just giving you some breathing room, anywhere from 1 to 3 months.
And they, meaning the lenders.
The lenders that, giving you breathing room to pay your mortgage at a future date, right? And sometimes that all comes in a lump sum at the end of those 3-month period, or sometimes they'll work it out and they'll smooth it over 12 months, but whatever, that's still going to be owed. Just like rent is still going to be owed, the mortgage is still going to be owed.
Sure.
But on top of that, when you have Fannie and Freddie backed loans, like majority of our properties do, right? There's other strings that are attached to, with regards to evictions and some other things. So we didn't want to go down that path. So that is why it's even more important to work with our residents and make sure the collections stay in line with where they need to be. But on the flip side of that, it's also an expense control, right? You have to, obviously work orders have gone down, right? Just because, it's just not safe to go in for every little thing. So we're doing emergency work orders. Obviously, a lot of our upgrades and CapEx have been put on hold too. So you're able to balance the 5 to 10% gap in revenue with a 5 to 10% reduction in expenses as well. So we're essentially flat for the month.
Yeah,
and so that's helped.
Right now, we'll see. I think next month will be a little different.
It could.
It's about being, just knowing how to be proactive and being able to be nimble. Right.
Yeah. So yeah, so those are some of the things that we're seeing, and some of the ways that we've tried to be successful in these trying times. But like Feras said, it's going to be evolving over the next couple of weeks. We'll see how it goes.
Yeah, I appreciate that. What are your thoughts of the outlook for multifamily for this year going forward?
My thoughts is I think multifamily cap rates are going to compress more. Right? Once we get through this, because you got to this point where the pad site Chili's was the same or a better cap rate than the apartment next door. But guess what? That Chili's doesn't have to be in business, right? As we've learned, right? And versus, multifamily, like I said, yes, we're collecting a little bit less. Yes, we're all impacted, right? But that's different than the Chili's that is getting $0, right? Or almost zero. Maybe they've gone online, but the analogy still stands, right? And so I actually think once this is all said and done in terms of real estate, I think multifamily will come out the winner, right? At the end of the day, that's what brought us to multifamily, right? We knew it was the safest bet, right? It's just why we're all attracted to it, right? People still need to live somewhere, no matter what's going on, good, bad, and ugly, right? And so then, I think it'll compress once it's all said and done. But right now, I think, there's definitely going to be some softening. I think for us, we're keeping a good pulse of the brokers, keeping a good pulse on, what's going on out there. Because I think there's going to be a lot of deals that are going to, deals that were bought way too skinny where they thought they were going to do these $300 rent pops and, whatever, right? They're not going to, I think those deals aren't going to happen. The deals that didn't have extensions baked into their loans or bridge loans, right? Those are going to start to blow up. And deals that, rising tide raises all ships, right? Well, right now, I think people that aren't operating well and operating too skinny, I think those people are going to get burned, right? And, that's going to those deals will start to come to fruition probably, in the fall. I'd probably take a little bit of a more negative stance on it. I don't know about cap rate compression. They were already pretty compressed as it was, but I do agree with Feras that 100% multifamily is going to be number one or number two asset class coming out of this. You're going to have, and it's going to be a little bit of something that we're going to look over the next 3 to 6 months. People will unfortunately lose their house, right? But once again, I go back to my thesis of multifamily in general, which is you have to have a place to live, right? And so that you're going to downgrade from a house to an apartment, right? So I think the A, B, and C class stuff, probably more so B and C, is going to still be resilient over the next, years to come because of that thesis, right? People need a place to live. You don't always need to have an office space or have a retail site. A lot of retail is going to get torched. A lot of office space is going to get torched just because people are reimagining how they're doing business. And, that is going to just, expand cap rates in those markets, especially. Maybe warehouses is where it's at, right? All the warehouses have been doing well. And then, in 50 years from now, whenever it's all matrix style, we just need to put people vertically in warehouses, right? So, that's going to be climate. That's what climate control. That's right? What will bring down. That's what will bring down. But there's still a bit of ways.
And pretty much the rest of the year, let's just say it's going to be a little dicey, but I think after that it's going to stabilize. I think we're still going to be in a good spot.
And then if we pivot to acquisitions, so just walk the listeners through your acquisition strategy, what type of assets you look to buy, your hold periods, target returns.
Yeah. Go ahead. Yeah, I'll take that one. So acquisitions, we're mainly focused on Texas, Georgia, and Florida. You know, as people had heard earlier, we mainly focus on Class B and C product, which is stuff that was built in the 70s and the 80s. We'll look at stuff that's a little bit older and stuff that's a little bit newer, right? That's not a hard and fast rule. We're tending to try to be 100, 150 units and above, right? Because what I always tell people is it's just as much work for me to buy a 300 unit property as it is to buy a unit. In fact, it's probably more work to manage the 30 unit after the fact. So we tend to focus on bigger properties. We tend to focus on stuff that's a little bit, has a value add component, right? Is being mismanaged, or there hasn't been any updates to the property's exterior or interior, where we can really come in with dollars and improve the property, therefore improve the rents that we're getting at the property itself, right? And, you know, I always tell people I can make the worst looking property look beautiful with the right amount of money. I cannot improve the area that it's in though, right? That's a public private partnership thing that's out of my control. Mm-hmm. So we really look at markets that make sense from a population growth, a job growth, and just in general are diversified in their economy, that are going to allow me to do my value add, improve that community, and then therefore the whole community itself, the overlying community, is going to get better. So that's kind of some of the things that we kind of look for.
No, absolutely. I mean, it's a macro to a micro, right? I mean, you start off focusing the markets in the areas that make sense, right? Are they resilient? Is their job growth? Is their population growth, right? You don't want to be in a city that is getting less people in it each year, right? That's a problem. And then, you know, from that, once you kind of know where you want to look, right? We work closely with the brokers and we get to know them and take notes on them. I spoke to a broker today and you took notes on, you know, but really knowing them well and build them into a friend and a partnership, right? And then, you know, those are the people that have a pulse on the deals. And maybe the only other thing to add to Ben is, you know, we do both agency and bridge, right? I mean, it depends on the deal. We try not to do too deep of value add. We've done the deal that goes down to, you know, 40% occupancy, that we brought it back to 95. You know, Ben lost the remainder of his hair on that one. But, you know, we'll do those kind of deals if they make sense. But those are, you know, those got to be home runs, right? I mean, and on top of that, we try not to have too many of those going on at once, right? And so it's more about what makes sense for that deal and that asset, right? We're opportunistic. We'll do a variety of plays if it makes sense.
Yeah. Are there any things that you get excited about in a particular deal? Whether, you know, specific things around that deal that make it attractive, or, you know, history of the tenant base, or
this is me personally. I like deals that all of the cruddy, you know, systems and exterior stuff has already kind of been done, right? Where we can really come in and work the interiors and the amenities, right? You know, because there'll be deals that are value add, but then you've got to spend half your budget doing roofs, or a quarter of your budget doing HVAC, you know, updates. And that's all that stuff it's needed. Your tenant and your residents expect those to be done and working properly, but you get zero rent growth from having those done, right? So we like somebody
those are hard to know to make look good too. That's the other part of it. Where someone that, you know, you're buying the property, you know it looks good, and your play is the interiors. The interiors are a lot easier to make them look good than it is for exteriors.
That's true. That's true.
That's another part of that. So I agree with that.
You know, so those are the kind of deals that we really kind of get excited about. We're like, oh man, he took care of all that other cruddy stuff that we don't really want to have to mess with, and we get zero rent growth from. And now we can go in and we can put $5,000 to make $100 rent pop, right?
And I think I agree with Ben. I think part of that too is with an exterior rehab, you kind of don't know exactly how much you're going to need until you get further along, right? Yeah. There's still so much that can go wrong. Versus an interior, I mean, end of the day, it's just down to a unit, right? So, and you know exactly how much, you know, countertops you're going to need and how much cabinetry you're going to, you know, those are very fixed things. So it makes it a lot easier to model and project. Versus if we're doing these bigger ones, you know, we just have to have so much more buffer in the deal, which again, we've done and we'll do them, right? But it's about getting us excited. It's really just those interior value added plays, right? That's one thing. I like deals where I show up and the manager clearly just does not know how to sell a thing, doesn't know what they're doing. Those are nice because those are easy too. It's like, okay, this is an easy
low-hanging fruit
play. So
you're so intimidating though, man. Yeah, that's why, you know, they're just nervous, man.
And so, you know, you look for those kind of things, right? Things where we know we can get in there, be a lot more efficient. That solves a lot of our problems. Yeah.
Any quick way for you to screen deals? Obviously, you see a lot of deals come across your desk. Anything that you do to quickly, you know, weed out, you know, this is a non-starter, or hey, this is one that we should spend more time on?
Yeah, So I'd say we have a very robust deal pipeline, more than anyone else I know. We've systematized that down to kind of an art as well, right? It's really, we do treat it as a pipeline. And so a couple things, just off the bat, right? Just looking at where the deal is, right? And just kind of the high level pricing guidance that they're given, right? We know our markets fairly well. We know, this is a market where this should be a 7 cap. This should be a 6 cap. That's one thing. The next thing is really looking at the occupancy and, the pricing that they're giving. Are they trying to sell it as if this deal was, stabilized and ready to go, but it's not? Or is it stabilized and they're asking fair market value? And then maybe the third thing is just getting an idea of where the rents are relative to the price per unit, right? And so, both of us came from the residential space. There's the 1% rule, right? Which is basically you want your rent to be 1% of what the purchase price is, right? And the housing, that's for housing. Well, actually, that same concept translates to apartments, right? So if I have a deal where I know the average in-place rent is $600, right? And that's one, if you kind of divide that by 1%, right? That means $60,000 purchase price. Well, if they're asking for $95 a unit and there's no way for me to get to $900 rent, I know that deal is probably not going to work out anytime soon.
No, we don't even have to underwrite it.
Yeah,
I don't even, I'm pretty much, what's the price per unit, what's the rent, right?
Sure.
Location is always
what's the in place and where do they think market?
Yeah.
I do want to know that.
If there's a clear path to getting, but most of the time there's not. It's just, there's such a disparity between the broker is selling it on a price per pound, but they're not even looking at what the rents are and they don't even care how they coalesce, right? And so we look at it like that and say, okay, and his example, right, I would say that's not even worth even underwriting. Regardless of the space or where it's located at, I just say,
you don't believe in $400 rent pops.
Yeah, especially now, right? I think that's the other thing too.
We see those pitched in northern Atlanta, that's a crazy.
COVID-19, right? We don't know where rent growth is going to be over the next 1 or 2 years, right? I think people should assume that it's going to be flat. And so we need to be, because occupancy is king, right? Collections is going to be key. Keeping the people there and keeping them paying is the most important thing. So underwriting, even if we can make sure because of the comps, everybody else is paying $950. I don't know if that's going to happen now, right? So even if pre-COVID, there might have been a clear path. There's probably not one now. And so those are some of the things that we kind of look for. But once again, real estate is always location driven, right? You can have the most rock star deal, but it's in some tertiary market in Podunk, wherever. I don't care if I'm buying it for $5K a door.
Sure.
Right. I will only be able to sell it for $5K whenever I go to sell it in 5 years.
Sure.
So it's just not worth the headache.
And then, you had given some quick heuristics of what you look for, that 1% rule, and that we find there's a high correlation between that and the deal, worth spending time on. Anything that are automatic deal killers for you?
Automatic deal killers.
I would say it gets to if you're at the below 70% occupancy range, once again, I have no hair left. I am not going to get into boarded up deals.
It's the deals that are not stabilized trading as stabilized. Those are automatic. Yeah, that's what it is, right? I'm happy to buy it if I'm buying at the right price. Sure. That's one. And the other one too is, man, at the end of the day, it's got to make sense price per pound. I see too many of these deals that are trading, like in northern Atlanta, you see these 60 deals that are trading for $140 a door.
Sure.
And I'm like, you're killing me. $140 a door, I can buy a brand new A-class and use it for one.
Yeah, it doesn't make sense.
It's got to feel right in the end. Because yes, maybe it makes sense on a cap rate, but it doesn't make sense kind of big picture. So I just
because to exit that deal and the returns that we need for our investors, you're selling it at $160 a door, right?
No, or even worse. I've seen deals like that, where they're buying them 180 and they're selling them at 240, and I'm like, deals don't sell for 240. That's just an insane. Yes, mathematically it all makes sense, but is there actually going to be a buyer on that exit? I don't think so.
No, I appreciate it, guys. This has been really helpful.
Right, the exit. Yeah. So so that's kind of some of the things I think we would probably say, we're not going to move forward on.
And then just given how hands-on you are, and even more so with the in-house property management, when you look at asset management, what KPIs do you focus on mostly?
I think that there's a couple of things, right, that you have to look at. You've got, obviously collections is king, right? Occupancy, that stuff. I look at traffic quite a bit. Where are traffic sources coming from? And from there, what's our leasing ratio to traffic? What's our actual getting a paying tenant in, because you could have people that fill out applications all day long, but if they're not qualified, then you're just wasting time, right? So I want qualified tenants that are going to fill out applications and actually get approved, right? So we look at those statistics quite a bit, because you'll find out, and the reason why you do that, right, is you find out that all your traffic is just from referrals or word of mouth, or just seeing you on the side of the road, right? But you're spending $5,000 a month on apartments.com and all these marketing tools online, and they're not getting you any traffic. Why are you spending $5,000 a month on that, right? And the other thing that people have to look at too, right? When you have a bunch of traffic, that also sucks time and resources away from your on-site staff too. So you have to make sure that they're qualified leads at the same time, right? So it's not all just about getting warm bodies walking in the door. They have to be people that can actually afford the rent. So
maybe to add one important one too is renewals, right?
Yeah,
Keeping the warm bodies that you have as well, right?
Yeah,
To me, that's
closing
huge.
the back door is huge, right?
If you're not on your renewals, I mean, that
because
you're in this never-ending cycle of trying to bring new people in.
Your exposure, especially in the workforce housing, right? It's the notice of vacates, the renewals, the people that you might have been filing eviction on, and then your physical occupancy. All of those combined can your exposure can be very, very high sometimes. And so you have to be ahead of that. You have to be looking at that 1, 2, 3 months out and saying, okay, hey, in June, our exposure is going to be pretty high, and exposure for your listeners is just the combination of all those things, right? So your physical occupancy might be 95, right? But you have all these notice of vacates, you have all these evictions that are going to slam you in June, and you've got people that you're still negotiating with on renewals. It could go either way, right? That 95 could quickly slip to 75 overnight, right? And now you have a big problem on your hands. So you have to be ahead of those metrics and being proactive in how you handle those things to be able to obviously be effective at asset management, right? Because we're essentially trying to increase revenue while keeping expenses in line, right? It's all about profitability when you're asset managing something.
That's really appreciate that. You guys, this has been fantastic. I know you have another event to get to. So just wrapping up here, what advice do you have for people getting into the business, both passives and first-time syndicators?
Keep grinding. I think a lot of people get frustrated if they don't find a deal in the first 3 months. Oh, this is too hard or too complicated or whatever. Keep pushing forward. Keep educating yourself. Keep networking.
It's the networking.
Yeah,
right?
I mean, once we
find
get
partners that maybe are better at other things, and you go find a deal and participate in some capacity. There's a lot of ways. What I like about this business, it's a team sport. There's a million ways to get involved in this business, whether you're passive, whether you're active, and everything in between. So
absolutely,
getting out there and kind of go to your local meetup, right? If you're in Houston, come to ours, come to yours. I mean, right? It's just getting out there, meeting and stuff.
Yeah. And you're doing this right now, Ryan. Keep making offers. It's a numbers game at the end of the day, right? I mean, if you stop underwriting deals, you stop making offers, guess what? It's just like you're never going to hit that home run if you never get up to bat, right? You've got to keep in the game, and you got to keep pushing forward. And eventually it will happen. Trust me.
Awesome, guys. Well, we really appreciate it. How can listeners get in touch with you?
So Ben at disruptequity.com, Feras, Feras at disruptequity.com. Our website is www.disruptequity.com. We're always happy to answer any questions. We love talking shop, as your listeners probably can tell. And we do have a meetup here in Houston. We're happy to talk about that too if they want to reach out to us.
Yeah, no, it's a great meetup. You should definitely come and check that out once these restrictions get lifted. You guys always have a great lineup of speakers, so really appreciate that.
Appreciate
awesome.
it.
Well, thank you so much for your
Thank
time.
you. That's right.
It's been fantastic.
All right.
Take care.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.